Welcome to the Deep Dive. We cut through the noise of corporate calls to get you the real strategic insights.
That's right.
Today, we're jumping into Sherwin-Williams' second quarter 2025 earnings call.
Always an interesting one in the coding space.
Absolutely. Our mission, as always, is to pull out those key nuggets, give you that shortcut to being really well informed about what's happening with this major player.
And understanding these calls, it's crucial. It gives you a lens, not just on the company, but the wider market dynamics too. It's about seeing that bigger picture.
Exactly. So let's start with the overall financial snapshot for Sherwin-Williams in Q2. Consolidated sales landed right within their guided range.
Which is solid, especially given how they talked about the market.
Yeah, they called the demand environment choppy. But what really stood out, I thought, was the gross margin. It kept going up. Expanded for the 12th consecutive quarter, year over year.
12 quarters, that's pretty impressive consistency.
It really is. What do you think is driving that even when the market's tough?
Well, it speaks volumes, doesn't it? About their operational discipline, their pricing power.
Right.
It suggests that even with demand headwinds, they can manage costs and keep prices strong. Probably comes down to the value they offer, brand loyalty, especially with pros.
Okay, and digging into the numbers a bit more. SG&A selling, general. Admin expenses, they ticked up in Q2.
Yeah, a bit higher.
But they're still saying they're on track for just a low single-digit increase for the full year.
Okay, so managing it overall.
But their adjusted earnings per share, the EPS, that metric everyone watches, it actually decreased this quarter.
Okay, so what was behind that dip?
They pointed to a few things. Higher non-operational costs compared to last year, interest, tax impacts, things outside the core business.
Gotcha.
Also, some new building expenses hitting the books earlier than planned. And, interestingly, deliberate targeted growth investments.
So that raises the question for you listening, right? An EPS dip, is it always bad news, or could it be, short-term pain for long-term gain? And in this case, it doesn't really sound like core operations are weakening. It seems tied directly to these forward-looking investments. They're choosing to spend now to position themselves better later.
Right, being proactive rather than reactive.
Precisely.
And on the capital allocation front, still disciplined. They returned $716 million to shareholders.
Wow, that's significant.
Yeah, through share buybacks and dividends.
Yeah.
That signals some real confidence, especially in a turbulent market.
Definitely shows they feel good about their financial health.
So let's shift to how management views the market itself. They keep using words like choppy, turbulent, and they flat out said, no help from the market expected for the rest of 2025.
That's a pretty stark assessment. No sugarcoating there.
So how does a leader like Sherwin-Williams respond when the environment is, as they put it, softer for longer?
Well, it means you have to be proactive, aggressive even. You can't wait for the market tide to lift you. You've got to generate your own momentum.
And they seem to be doing that, doubling down on restructuring, for example.
Yeah, more than doubling. From an initial $50 million target up to about $105 million.
Looking for $80 million in annual savings from that.
These aren't just simple cuts, mind you. They're strategic moves aimed at streamlining, boosting efficiency for the long haul.
They're also speeding up the move to their new global HQ and R&D center. That pulled some costs into Q2.
Which suggests they want to start seeing the benefits of those big projects sooner rather than later. Makes sense.
And here's something interesting. Despite those big investments, they actually reduced their overall capital expenditure plan for the year. Cut CapEx by $170 million.
Oh, okay. Down from $900 million to $730 million. So pulling back somewhere.
Yes, but, and this is key, they stressed they're maintaining the strategic projects. Things like the Statesville architectural capacity expansion, warehouse automation, coil capacity expansion, those are still full steam ahead.
I see. So that's quite telling, isn't it? It's a nuanced approach.
How so?
Well, they're deferring maybe less critical spending, trimming the fat, but they are absolutely protecting the investment's core to their long-term advantage.
Like capacity and efficiency.
Exactly. Investing to meet future demand, especially for the pros, and making their supply chain smarter with automation. It's not just cost-cutting, it's smart capital deployment, strategic, positioning for the recovery.
Right. And meanwhile, they're still doing opportunistic share buybacks, pursuing acquisitions like Suvino, which they expect to close by year-end.
So yeah, definitely not a company just hunkering down. They're actively trying to shape their future, even with the headwinds.
One phrase from the call really jumped out at me. Management called the current competitive landscape a once-in-a-career opportunity.
That is a strong statement. Bold.
What are they seeing that makes them so confident, especially when others seem to be struggling?
Well, they're pointing to significant weakness among their biggest architectural competitors.
Like what kind of weakness?
Things like competitors cutting customer-facing staff, selling off assets, and apparently one competitor even tried a disruptive high single-digit price hike right in the middle of the peak selling season.
Ouch. That probably didn't go over well with contractors.
Likely not, and this creates a vacuum, right?
Yeah.
Sherwin-Williams, with their stability, their predictability, their discipline, they can step into that space.
So they're not pulling back.
Quite the opposite. They're investing aggressively in their paint stores group, the PSG segment, adding customer-facing initiatives. They seem really confident this strategy will drive above-market growth when demand turns.
And they've been building towards this, haven't they, since 2019, adding over 400 new stores, 500 new reps.
Exactly. It's not just reactive, it's a calculated long-term play for market share. Their point is that pros want reliable partners, especially now. Predictability, solutions.
And Sherwin-Williams feels they're delivering that, basically building their moat wider while others are, maybe treading water or retreating.
Oh, that seems to be the thesis. It really highlights that strategic choice. In a tough market, do you invest steadily like they are, or do you make disruptive moves or cut too deep? Their bet is clearly on consistency and long-term relationships.
Okay, let's dig into the segments then. Starting with that core paint stores group, PSG sales were up low single digits.
Right.
But here's the interesting part, that growth was driven mainly by mid-single-digit price mix. It actually offset a low single-digit volume decline.
Yeah, that's a powerful sign. Price increases alone are driving growth, even with slightly lower volume.
What does that signal to you?
It says a lot about their brand strength and customer loyalty, particularly with the professional painters. Even if those pros are buying a bit less paint overall, they're sticking with Sherwin-Williams and accepting the price. Shows robust demand for what they offer.
Definitely. And within PSG, residential repaint, a huge category for them, grew mid-single digits, significantly outpacing the market, they said.
That's strong.
And new residential sales, up low single digits, which is pretty amazing when you consider that market-wide single-family completions were actually down double digits.
Wow. Okay, so that's not just weathering the storm.
No. And commercial sales also grew low single digits, even with multifamily completions dropping mid-teens.
That screams market share gains, doesn't it? If the market's down double digits in areas and your sales are up, you're definitely taking business from someone else.
Reinforces that once-in-a-career opportunity idea.
Absolutely. Shows the strategy to capitalize on competitor weakness seems to be working in real time.
And they're still expanding PSG's footprint. Opened 20 net new stores in the quarter. That's 38 year-to-date, ahead of last year's pace.
Investing in that physical presence.
And importantly, segment profit increased, and the segment margin only dipped slightly, despite all those growth investments.
That's impressive. Growing profit while absorbing costs for new stores and reps with only a minor margin hit. It suggests that core pro business is really healthy and efficient, or maybe those investments are paying off quickly.
Okay, let's switch gears to the Consumer Brands Group, CBG. That was a different story. Sales were below expectations.
Yeah, sounded weaker there.
Volume, price mix, foreign exchange, all down by similar low single-digit amounts. What's going on there?
Well, that segment really reflects the ongoing softness in the North American DIY market, right? People doing fewer home projects themselves.
Seems like it.
Europe provided a bit of an offset, but overall, CBG faces a tougher environment than the pro side. Consumer confidence, discretionary spending still under pressure.
And they mentioned the store count in CBG decreased slightly, 325 down to 312. But that was mainly transitions in Brazil, shifting from company stores to dedicated dealers.
Ah, okay, so more of a channel strategy shift than just closures. Got it.
Right. Finally, Performance Coatings Group, PCG, the industrial side, sales were in line with expectations.
Okay, steady there.
Volume, acquisitions, FX were all up low single digits, slightly offset by unfavorable price mix. Any bright spots or particular challenges within PCG?
Packaging was called out as a bright spot again. Double-digit growth, including in acquisitions, so strong demand there, maybe tied to consumer goods.
Right.
Coil sales were up low single digits, also with an acquisition boost, but they said the outlook there is getting murkier.
Why murkier?
Uncertainty around steel tariffs, which could obviously hit demand for coil coatings down the line.
Makes sense.
Industrial wood and general industrial were down, kind of as expected given broader industrial trends. Auto refinish was down slightly too.
Lower insurance claims, maybe? fewer accidents.
That's what they pointed to, lower claims hitting their core accounts.
Yeah.
But they did mention some meaningful new account wins, which is encouraging, helping to offset some of that softness.
Okay. But the profit and margin for PCG did decrease. What drove that?
Primarily higher costs to support sales, some higher foreign currency transaction losses, and also not having a gain from an asset sale they had last year. So a mix of factors hitting profitability there.
Okay, so putting it all together, let's talk outlook. They updated their full-year guidance, including a reduction in the adjusted earnings guidance.
Yeah, dialing back expectations a bit.
What's the main reason for that adjustment?
It seems to be largely based on those architectural sales volumes coming in softer than they initially thought for 2025.
Okay.
And also some supply chain inefficiencies, mainly because they're producing fewer gallons globally. But they are partially offsetting that hit by cutting back on SG&A spending. Shows that cost management flexibility again.
Got it. On a slightly brighter note, though, it sounds like the raw material picture is improving a bit for them.
Yeah, that's the flip side of softer demand sometimes. They now expect slight deflation in their raw material costs in the second half of the year.
Leading to flattish costs for the full year.
Right. Driven mainly by petrochemicals, solvents, some resins, but they're still watching tariffs on things like pigments and extenders as a variable.
So what does that raw material shift really mean in the grand scheme?
Well, connecting it back, while the guidance cut reflects the reality of softer demand right now, that improving raw material outlook gives them a bit of a margin tailwind. It helps cushion the blow from lower volumes. It's about managing what you can control costs, spending when you can't control the overall market demand.
Right. Okay, so we've gone through the numbers, the strategy, the outlook. It really paints a picture of a company making some bold moves in a tricky environment.
Definitely playing offense.
Which brings us to a fascinating point. How might someone think about this strategically? And just to be crystal clear, this next part is purely a thought experiment. It is absolutely not financial advice.
Couldn't stress that enough. Entertainment and conceptual discussion only, not advice.
Okay, disclaimer delivered. So pitch us an outrageous but plausible trade idea based on everything we've just discussed from this call.
All right. Here's one for you.
Okay.
Go long, a long-dated, deep-in-the-money call option on Sherwin-Williams stock itself.
Okay, long Sherwin-Williams via options. What's the other side?
Simultaneously, you'd short a basket of, say, publicly traded DIY retail chains, or maybe residential home builders, companies really exposed to interest rates and shaky consumer confidence.
Interesting pair trade. Long Sherwin, short DIY home builders. Walk us through the thinking there.
Okay, so it leans right into that once-in-a-career opportunity narrative from Sherwin-Williams.
Right.
The short leg, shorting DIY home builders, that's your hedge against the softer for longer macro environment that broadly hurts those sectors.
Okay, bidding against the general housing DIY weakness.
Exactly. But the long leg, the Sherwin-Williams call option, that's the bet on their specific strategy. Despite the weak macro, they are investing heavily in PSG, opening stores, adding reps, taking share from weakened competitors.
You saw that in the numbers, outperforming the market significantly in residential.
Precisely. They're positioning themselves for potentially disproportionate growth when demand does eventually pick up, maybe 2.5, 3 times the market rate like they've suggested they can do.
So the bet is on their discipline and market share grab paying off big time down the road.
That's the core idea. Betting on strategic execution and that widening competitive moat during turbulence. It's basically a bet on who's actively building for the future versus who's just trying to survive the present.
That is quite the play. Really encapsulates the story they're telling.
It's about seeing who's using the downturn as an opportunity.
So to wrap up our deep dive on the Sherwin-Williams Q2 call, the big theme feels like disciplined, aggressive strategy in action.
Yeah, they're not just reacting. They seem to be actively trying to expand that competitive moat, seeing this tough period as a real chance to gain ground.
Right. They see opportunity where others might just see challenges.
Absolutely. This deep dive really shows a company looking long-term, investing through the cycle, betting on their core strengths, and capitalizing on competitor uncertainty, setting themselves apart.
Which leaves us with a final thought for you, the listener, to chew on. How does a company's choice to invest heavily during a downturn fundamentally alter its path compared to competitors who pull back?
What are the broader lessons here about having a long-term vision, especially when things feel volatile?
Something to think about. We'd love to know what stood out to you from this deep dive.
Definitely reflect on those dynamics. How might they apply elsewhere?
Well, thank you for joining us on this deep dive into some compelling information.
We hope you found it insightful.
And we look forward to having you with us for the next one.